So when I arrived in the US 20 years ago, it was striking that the US had more consumer-friendly markets than Europe had. When we say competitive market, what we really mean is consumer-friendly. That is, for an economist, the market is competitive if consumers have low prices and lots of choices. Okay, that's exactly what we mean. And it was strikingly so in the US. You could get cheap internet connections, you could get cheap laptops, computer equipment, all kinds of electronics. You could buy a cell phone, the cell phone plan was cheap, and you could fly to conferences because airlines were competitive and airline tickets were cheap enough that even me as a student, I could afford it. Let's start with one of the prime example, the cost of internet access at home. So this shows you the broadband cost per month for the same speed, right? So for the same quality of product. As you can see, every country in the world is somewhere between $30 and $40 per month. So France, Korea, Germany, the UK, Japan, all of these countries, Italy, Spain, all of them are in this ballpark. But the US is twice as high as everybody else. Okay, so literally, if you're a US household and you want to have a broadband connection at home, you're paying twice what the same household would pay in London or in Manchester. Okay, so that is a big change. In fact, it's a reversal because the US used to be cheaper. Now, how did that happen? Well, in the telecom industry, over the past 20 years, there's been a wave of consolidation and increasing markups. So 2000, that's a sweet spot. That's where I got arrived in the US. As you can see, concentration and markups are very low. So markup is in green, concentration is in red. The markup is, you can think of it mostly as the profit margin, like how much they are making for each unit of revenues. And it has gone up by about 40 percentage points, which is a very large increase. Concentration measured on the right is CR8. That's the market share of the top 8 firms. This is very volatile for many reasons, but you can see there's a clear upward drift by about 20 percentage points over this 20 or 30 over this sample period. So these facts are not that controversial, although there are measurement issues that we can come back to. What is very controversial is what they mean, is the interpretation. And at the risk of simplifying a bit, I'm gonna call them good and bad concentration. These are the two polar interpretations. The good concentration is when you think that the increase in concentration that you see is happening because firms that were already very good, that were already industry leaders, have just become even better. Okay, so then as a consequence of that, their market share is going to grow. You're going to measure higher concentration. But it's not necessarily a bad thing. It just means they are just getting better. Maybe they are running faster than the rest. And therefore, their productivity is going up. And so is the productivity of their industry. So maybe everybody's benefiting from it. Typically, it comes together with a lot of intangible investment when you see that in the data. The bad concentration explanation is exactly the opposite. It says that no, the reason these firms manage to maintain such high profit margins and market shares is because they are preventing entry. They are preventing competition. And therefore, you don't expect any good outcomes. And in fact, under the bad concentration hypothesis, you would expect high prices and low productivity. It's not hard to find examples of both in the US. Clearly, if you look at the retail and wholesale trade sectors, they fit very well the good concentration story. If you look at telecoms, airlines, and healthcare, they fit quite well the bad concentration story. But what about all the industries in between? Are they more or less in the good camp or in the bad camp? Okay, so that's what I'm trying to do. So I go through all kinds of measurements of competition in the US, and I show that whether you look at profit margin, prices, investment in intangible asset, productivity growth, investment, entry, turnover at the top of industries. All of these point toward the fact that there's been less competition in many industries. Now, if you look at the data very broadly with all these proxies at the same time, you can construct an index of good and bad concentration. The one called intangible, PC1, so it's the first bulk of data based on intangibles, it's because it loads heavily on intangible. It tells you this is concentration, but it comes together with intangible investment and fast productivity growth. And as you can see, it's increasing in the 90s and then it's kind of flat. So I'm not saying it's disappearing. I'm not saying that there is no industry today that goes through this good cycle of concentration. There are always some. But what is striking is that the other type of concentration, the one where we don't see all the good stuff, we don't see the productivity, the low prices and stuff like that, this has become relatively more important in recent years. And today it's actually more prevalent than the green type. Okay, so that's my main claim about the US. At this point, you want to ask yourself, well, is it more technology or is it more policy? Is there something we should be doing? That's a tricky question, obviously, because we don't know exactly what's driving this concentration. And it's very hard to disentangle technology from policy because typically the two move together. That's where Europe is especially interesting because there are some industries, in fact, most industries, where Europe and the US use the same technology. If you think about the telecom industry, airlines, essentially all the transportation industry, all the consumer goods, pretty much the technology is exactly the same in Europe and in the US. I'm looking at all the industries that have the same types of firms on both sides of the Atlantic. And I'm going to see whether the evolution is the same in Europe. And it's not. And it's part because Europe has tried to push to make its market more competitive over the same period of time. So starting in the mid to late 90s, as we move toward the single market, we start to implement product market reforms. So PMR is a product market reform index. And this is telling you that at the peak, around 2000, we have one major reform per country per year. What's a PMR reform? Well, here's one of my favorite examples, the telecom reform in France. So this is when we introduce a fourth competitor in an industry that used to be dominated by 3 incumbents. So throughout the 2000s, we have 3 major wireless carriers, and classic oligopoly, they all charge the same price. There's a fourth entrant, Free Mobile, who's asking for a license, gets denied its license under heavy lobbying by the incumbent. And then in 2011, the regulator gave Free a license, a bunch of spectrum, so they can enter. When they enter exactly at half the price of the incumbent. The incumbent were providing the unlimited texting, voice, and a bunch of gigabytes of data for 20 euros per month. Free, so for 40 euros per month, Free enters at 20 euros per month, so half the price. And within 2 years, the incumbents had to match, right, because they were losing customers. So that what that means is that even if you did not change your cell phone plan, then the price on your mobile plan would essentially be divided by 2 in 2 years. So that's a huge improvement in your standards of living. That's all because of entry. So this is the markup, that's the price relative to unit cost of labor. It's about flat, slightly declining in Europe. It's increasing in the US. It's increasing, and based on this analysis, my best estimate is that prices in the US are about 7% too high. So 7% too high, that's about $300 per month per household. It's about $600 billion of consumer spending per year, if you put 12 months and all the households together. And it corresponds to a waste of $1 trillion of private GDP in the following sense. Suppose you took the economy as it is today and you made it as competitive as it was 20 years ago. So you would get rid of this extra 7% distortion. Then standard macroeconomic model predict that private GDP would go up by about $1 trillion. And on top of it, because you would push down profit margins, you would push up labor income. So labor income would go up by, in fact, more than $1 trillion. Profit would go down by $250 billion, and labor income would go up by $1.25 trillion. So the main beneficiary would be the middle class. For the middle class, for people who earn around 50,000, for households earning about $50,000 per year, that would be a 10% improvement in their standards of living. So what happened? I don't think I have a full understanding of what happened, why it happened, when. I can point to a couple of proxy explanations, and the main one is lobbying, which is, if you think about what is it that changed in the 2000s, together with all these negative evolutions, Well, clearly lobbying did. Okay, so this is the evolution of lobbying in the US. And now I have data going back further. I can show that it was quite stable as a share of GDP, for instance, in the 90s and late 80s. But somewhere around 2000, it started to increase a lot and reach levels that are about 2 or 3 times higher than Europe. Okay, so lobbying is not something firms do for fun. They do it because they have a definite goal in mind. Okay, and usually this goal is to influence regulators or policymakers in their favor. And for whatever reason, started doing more of it in the 2000s, and they started to be more successful in the 2000s. This is how you sustain a system where prices are high, profit margins are high, consumer get a bad deal, and somehow the policymaker don't do anything.